Welcome! This is part 1 of chapter 1. We first look at taxes in general, and we acknowledge that there are 3 basic criteria that define a tax. And we note some of the history of taxes. This is a chart illustrating how taxes have changed over time, but the real point of this chart is to understand that during World War II, we had this dramatic increase in the taxes as a percentage of our gross domestic product. And since then, despite the little bumps up and down, it's stayed pretty level. Here is a list of 5 major federal income taxes. In this class, we're focused on the income tax. But there are other taxes that the federal government also assesses and collects. 2 that are commonly misunderstood are transfer taxes, the estate and gift transfer taxes. These are transfers of wealth. Again, this is income we're looking at in our class, but individuals also transfer wealth. Of course, a gift is a transfer of wealth, or someone passes away and their estate transfers their assets to the beneficiaries. So what you would have is you have one party, let's say it's an estate, you have a decedent who's going to then pass property on to his heirs or beneficiaries. With a gift, you'd have a donor who's passing property on to the donee, or again, beneficiaries. The tax is assessed on the transferor. It is never assessed on the heirs or the beneficiaries or the donee. So keep that in mind. Also, with respect to the gift tax, there's an annual amount that can be given before a gift tax even comes into play. So every year you can give away up to $15,000 to each and every person you like. So in other words, if you knew 2 people, you could give $30,000 away, 15 to each. Married couple, likewise, collectively they could give $30,000 to each of their children. If they had 3 children, they could effectively give $90,000 a year, and they would never have to file a gift tax return on that. Okay, but above the $15,000, then a gift tax return is required. Okay, in terms of some taxes you're more familiar with, we have the employment and the unemployment taxes, typically just referred to as payroll taxes because they're collected via payroll. If you've looked at your pay stub, or even your W-2, but your pay stub is probably it's easy to see. You'll notice that your employer has withheld federal income tax. If you're in a state that has an income tax, it would be also state withholding. Texas, we don't have that, but they'll also withhold payroll taxes. Typically, these payroll taxes are 2 major ones: FICA and Medicare. These are sometimes referred to as the Social Security taxes. And those are withheld on most employees up to fixed dollar amounts. I won't get into specifics here, but everybody who's working is going to have those taxes. The last we list here is the excise tax, and a good example of that is gasoline. Federal government assesses an excise tax on gasoline, but on other items as well, liquor and cigarettes and things of that nature. At the state level, we also have taxes that are assessed, and you can again see that there's an income tax. Most states do assess an income tax. In Texas, we don't have an individual income tax. We do, however, have a franchise tax, so corporations are still subject to a tax in Texas. There's also a sales and use tax, and I think most of you probably understand what a sales tax is. You walk into Walmart, you buy something. Often Walmart's going to then collect a sales tax from you in addition to the purchase price. And Walmart is going to then turn around and send the sales tax they collect to the state. The use tax is not well understood and is probably going to become even less used in the future. Use tax would be you're buying something that is not subject to a sales tax, but you reside in a jurisdiction where you should be paying a use tax on using something. So it's maybe you bought something through the mail, they delivered it, wasn't subject to sales tax. Now you are supposed to send in a use tax. Most people don't do that. And we've had a recent Supreme Court ruling that's going to allow states to start collecting sales tax on stuff that's delivered to you from out of state. So again, use tax not as important in the future. Property taxes, typically assessed on your personal property as well as real property. So you might have a car, which was considered personal property. You might also have a home, which would be real property. Excise taxes, again, gas. So if you're at the pump, look, there's a federal and a state excise tax. A state tax. Most states don't have an estate tax, but a few do. And employment taxes, again. At the state level, we have unemployment taxes, the FUTA tax, but we're not going to spend much time with that in this class. This lists the breakdown of revenue to the federal government, and you can see a heavy reliance on the individual income tax, the focus of our class. This lists the expenses and the allocation, and you can see that the entitlement spending here is significant. Entitlement spending being Social Security and other sorts of transfers from the federal government to various individuals for various reasons. You can also see defense takes a fairly good amount. And the way to kind of tie this together, incidentally, is to connect the colors. But you'll also notice that we spend more than we take in. These are some basic terms to try to get familiar with. In particular, this idea of an exclusion. It means it's not subject to tax. So some item that's excludable would not be subject to an income tax. Also the idea of a deduction. It's a reduction in the amount of the tax base. In our class, the tax base will actually be referred to as taxable income, but it's whatever basis the tax is levied on. And then, of course, there are rates, which create a tax, and then sometimes you're allowed credits against those for various activities that have been undertaken. So this is the basic framework. You can see the definitions on this page, so spend a few moments familiarizing yourself with that. Taxes can be assessed a variety of different ways, and different taxes are assessed a number of different ways. The most commonly understood is the progressive tax rate, which essentially increases as your income goes up. So there's an increasing, so it's progressive. It becomes progressively increasing as your income or your tax base goes up. The proportional is typically referred to as a flat tax. So this is just your income goes up, but the tax rate stays the same. And regressive is just simply the reverse. It goes, your income is going up, but the tax is going down. I don't have very many regressive. They're typically believed to be quite unfair, but there is one out there. This is simply asking you to map it, and I already have done that for you. Here you can see essentially what happens with these different types of tax structures. A little history in terms of where we've been in rates. I'm sure you're glad you're not living back in the 1930s because those high rates were really high. We've brought them down recently, so the top rate is now 37%. For corporations, there's also been a significant reduction. You can see we've dropped that top rate from 35% to 21%, a big change there, but not everybody was a winner. There was, for some, a tax increase. Social Security, as you can see, which is, again, just for clarification, this is also referred to as FICA or the Medicare. There's two components to this tax, and this is the total for an employee if you're this would be, an employee, let me get this right, and the employer together. If you are self-employed, you're going to have that tax, plus you could be assessed a little bump up here. There's a surtax. We'll talk about that in another chapter. I don't want to bog you down with too much detail right now. All right, in terms of different types of tax rates, news media likes to quote different types of rates, so it's somewhat helpful to understand what we're talking about. If you've taken an economics class, you understand this concept of marginal. So it's the next dollar. So here's where I'm at. I'm going to have an additional dollar. What is that going to do to my taxes when I move over that increment, that threshold? The average is I just take my total tax over my total income, or whatever my base might be. So fairly basic idea, easy to calculate. And the effective is now going to take that total tax. And now we're looking at something broader. I don't think I have spelled that correctly. And so we get into this distinction of not all income is subject to tax. And so the effective tax rate is actually lower than the average tax rate because, again, we have exclusions, we have deductions. Here's an example. So Jay has economic income 140 and has a tax base of 100 and has a tax of 25. So we can calculate two of these taxes really fast. This was how we do the average, and this would be the effective tax rate, right? We're looking at economic income as the denominator versus the actual tax base. So we can quickly calculate out those tax rates. We also have some information about a marginal rate. So he's going to earn another $1,000 of additional income, and he's going to have, as you can see, a $300 increase in his tax. So we could calculate out that he's got a 30% marginal rate. We could see he's got a 25% average, and if we do the math on that, I think it's about 18%. And you can see this slide is wrong. It is 30%. So what about tax structures? Well, if you're trying to determine whether the structure that the individual faces is progressive, proportional, regressive, just compare the marginal to the average. If they're the same, then you're flat. Nothing's changing. If the marginal is higher, then you're progressive, and if it's lower, then you're regressive. One concept to keep in mind is that not all taxes are explicit taxes. Explicit taxes are easy to see because you pay them directly to a government. Implicit taxes are harder to see. They're still there, but they're hard to see because the payment doesn't go directly to a government. It goes to a third party. Most of the time, you can figure out who that third party is, but nonetheless, there's still a tax. It's just the government is allowing you to decide who's really going to be the beneficiary. An example here which tries to illustrate this concept. So assume we have someone with a opportunity to invest $10,000 in some bonds, and he could either buy some taxable bonds, which would have a tax assessed. He's got a marginal rate here of 30%. So he'd have a tax assessed, let's say $150. He would net with $350. This after-tax return is the 3.5%. Alternatively, he could buy a tax-exempt bond, which I'm going to say is issued by the state of let's make it Texas. I started that not very well, but let's say it's the state of Texas issues that bond. There is going to be no income tax assessed on that. And again, we're talking federal here. We know that Texas is not going to assess that tax either, but there is no federal income tax assessed on that bond. So the thing that's happening here, though, is the bond is paying a lower interest rate. The market rate is 5%. But this bond is able to be purchased, and it's only yielding 3.5%. So effectively, the purchaser of the bond has paid that $150, but instead of paying it to the federal government, as in the first example with the taxable bond, it's now actually being a transfer over to the issuer of the bond. So in my example, Texas was the issuer of the bond. So it's an implicit tax. Implicit is going to the issuer of the bond. That sums up this first part, so thanks for listening.